All right, let's cut right through the noise. Welcome to today's Explainer. Today, we are putting on our strict binary analyst hats to deliver an exclusive institutional-grade morning briefing. We're looking directly at the August 5th, 2026 market volatility, and we're performing a purely clinical market autopsy on the global capital markets. Look, if you're managing capital right now, you absolutely cannot afford to operate on outdated narratives. We're going to ruthlessly deconstruct the market's plumbing, expose some serious institutional confirmation bias, and look at the exact mechanical forces that are driving asset prices today.
So here is our roadmap. We'll be clinically outlining 5 mechanical pillars today. First, the macro discourse, where bad is bad. Second, the anatomy of institutional bias. Third, the liquidity drain and the gamma squeeze. Fourth, the duality of AI capex. And finally, we'll wrap up with a highly tactical portfolio reallocation matrix.
Let's jump right into our first pillar. Section 1, Macro. Bad is bad. We have reached a fundamental psychological breaking point in the macroeconomic paradigm. Remember when the market operated on a bad is good framework? That era where weak economic data was actually celebrated because it meant the Fed would just rush in with rate cuts? Well, that is officially over. Just look at the exact chronological sequence that irrevocably shifted the global narrative. First, US Q2 GDP dramatically decelerated, missing expectations at 1.5%. Then, the Fed completely stripped away its forward guidance for imminent rate cuts, locking us into a higher-for-longer reality. Third, the 30-year Treasury yield spiked to 5.27%, a level we literally haven't seen since the 2007 financial crisis. And finally, Moody's downgraded the U.S. credit rating to AA1. This means all 3 major rating agencies are now uniformly warning of systemic fiscal risk. This sequence completely shattered the old narrative. Today, bad data no longer promises a dovish Fed pivot, it just promises a direct, unmitigated threat to corporate profit margins. Bad is now just bad.
The immediate consequence of that shift is flashing right in front of us, 4.62%. That is the 10-year Treasury yield as of early August. Now, this isn't just a random number. It's a structural repricing of the risk-free rate. Because this yield is climbing so aggressively, it's acting like a gravitational pull, mechanically compressing the S&P 500 forward price-to-earnings multiple. We've watched it get squeezed from 20.6 times down to 19.7 times. So even though Q2 earnings growth was actually incredibly strong, this mechanical discount rate shock is just pulling valuations right back down to earth.
But it gets worse when you start digging into the underlying factors. We are looking at a highly toxic combination. Headline CPI is stubbornly stuck at 3.5%, and core PCE is sitting at 3.3%. So inflation is definitely not defeated, it's incredibly sticky. But at the exact same time, consumer sentiment has just broken down to 45.1, plunging much deeper into contraction territory. Think about that. You have inflation persisting while the consumer is suffocating. This is the absolute textbook definition of stagflation risk, and it effectively neutralizes any potential for the Fed to ride to the rescue with dovish monetary policy.
Which brings us to our second pillar, Section 2, Anatomy of Institutional Bias.
With the macro foundation shaking like this, how are the biggest players reacting? Well, you cannot blindly trust a single institutional narrative right now. We are seeing extreme divergence across Tier 1 investment banks, and commercial interests are driving massive data selection bias. Look at this stark juxtaposition. On one side, you have Goldman Sachs projecting an incredibly aggressive S&P 500 target of 8,000. They're pointing to a record surge in IPOs and a staggering 63.2% earnings growth from the Magnificent Seven. But you have to remember, Goldman has a massive underwriting and M&A business to defend. They need a bullish narrative. On the exact opposite side, Morgan Stanley is issuing a severe defensive pivot. They're explicitly warning that a 10-year yield over 4.5% will mechanically crush growth stock multiples, and they're advising a rotation into quality value and defensive assets. You're watching 2 Wall Street titans look at the exact same market and draw entirely conflicting structural logic based on their own inherent biases.
And if you really want to see how fractured the consensus is, just look at the interest rate projections. Bank of America is modeling 3 consecutive 25 basis point hikes this year. Meanwhile, Citi is modeling 3 consecutive 25 basis point cuts. That is an unprecedented 150 basis point chasm between 2 major banks. At the same time, the Kalshi prediction markets are entirely split down the middle, roughly a 49% chance of a hold and a 47% chance of a hike. This specific historic variance is injecting maximum pricing uncertainty into long-duration equities. The reality is, nobody actually knows the true cost of capital 6 months from now.
Let's move to our third section. Section 3, Liquidity Drain and the Gamma Squeeze.
We're going to pivot away from the headlines now and look directly at the hidden market microstructure.
Because the recent resilience you're seeing in equities, it is not fundamental strength. It's a mechanical distortion. To understand why, you need to understand reserve drag. Simply put, this is the mechanical depletion of commercial bank reserves. It happens when the U.S. Treasury sucks cash out of the system to aggressively rebuild its general account, known as the TGA. The Treasury plans to rebuild the TGA to $950 billion by September and potentially over $1 trillion by October. Now, normally, the financial system has a buffer to handle this liquidity drain called the overnight reverse repo facility.
But look at the reality we're facing right now. $2.25 billion. That is the near-zero balance of the reverse repo facility as of early August. At its peak, this facility held trillions. Today, it's effectively empty. The critical liquidity buffer defending the financial system has been completely depleted. So, as the Treasury rebuilds its cash account, it's now going to directly suffocate systemic liquidity, pulling capital straight out of commercial bank reserves.
So you're probably asking, if liquidity is draining so fast, why hasn't the market collapsed? Because of this exact number, 66.2%. That's the percentage of all S&P 500 options volume that is now made up of 0 days to expiry, or 0 DTE options. This is a historic high. The index is being artificially propped up by the derivatives market. Following major tech earnings, we saw a massive volatility unwind. And when volatility drops, market makers are mechanically forced to buy the underlying stocks to hedge their options exposure. That's a process known as a gamma squeeze. What you're seeing right now is forced robotic buying by market makers. It is not real, fundamental institutional buying. It's an illusion of stability.
Which brings us to Section 4, the duality of AI CapEx. While the broader market is staring down a liquidity crunch, we are seeing a violent polarization in capital allocation right beneath the surface. The divide is staggering, $182 billion. That is the massive second quarter capital expenditure by just the top 5 big tech firms alone. We are witnessing a forced structural investment cycle. These tech titans are locked in an absolute arms race to build out physical AI infrastructure. And that creates a definitive, unbreakable floor for the companies providing the hardware, the cooling, and the power for these massive data centers.
But there is a catch here, which we call the CapEx clearing price. Take Alphabet, for example. They have $43.8 billion in off-balance sheet guarantees just to secure hardware, which pushed their free cash flow negative by nearly $6 billion this quarter. The market is beginning to aggressively penalize these hyperscalers that are spending these astronomical sums without demonstrating an immediate, massive return on investment. So the alpha is rapidly shifting. It's moving away from the software giants placing the orders and moving directly into the physical hardware supply chain that is cashing those checks.
Section 5. Tactical Portfolio Reallocation.
So, how do you actually trade this environment? We have a strict, binary portfolio execution plan designed for surviving this impending collision between draining liquidity and persistently high yields. Here is the exact institutional reallocation matrix. First, overweight digital infrastructure and cooling. We're looking at companies like Saint-Gobain and Kingspan that directly capture that $182 billion big tech spend. Second, overweight physical gold. Central banks are buying, and with an optimal entry target between $4,100 and $4,500, it's a mandatory 10% portfolio hedge against fiscal instability. Third, overweight cash and short-term CDs. With platforms like E-Trade offering a 4.40% APY, you need to park capital in the safety of high-yield cash equivalents while the systemic liquidity drains. On the flip side, you ruthlessly underweight residential construction. High yields have completely strangled the housing market, making names like NIBE and Garrett highly vulnerable. And finally, underweight legacy software. They are facing severe existential disruption risk from the very AI models being built right now.
I want to leave you with this final critical thought. We've established that the true liquidity buffers are essentially at zero. We know the Treasury is about to suck hundreds of billions of dollars out of bank reserves. And we know that the current index price is being held aloft by a 66% zero DTE options gamma illusion. So the single most important question you have to ask yourself right now is this. What happens to asset prices the exact second that mechanical short covering ends? Are you positioned for reality, or are you betting on a mirage? Thank you for joining me for this explainer. Stay focused, stay objective, and always respect the data.